Hello everyone, how are you guys this morning? So today I'm going to share with you the topics about risk and materiality. So risk and materiality is very important for in audit because it actually helps you to identify the risks of the organization so that you guys will be able to have a proper plan of audit and to make sure that you are actually auditing the right thing. So for this particular topic, we expect the student to attain this objective. One is to understand audit risk model. So we are going to share with you the audit risk model, understand what is risk and audit risk model, and how does this particular risk fit in the client risk assessment. And then the next part will be the explain what is materiality and its applicability in audit engagement. And the last part is you must be able to explain the relationship between risk and materiality. Then basically just want to give a simple analogy. If you want to travel from one place to another place, for example from Penang to Kuala Lumpur, maybe you have alternative whether you want to use train or or maybe you want to use train, or maybe you want to use an aeroplane. So here when we talk about using alternative modes of transportation, what do you anticipate is maybe an accident. So here choosing of using train or using an aeroplane, your risk of accident say about 5% rate of accident in train and 5% of risk of accident in aeroplane. So when you see at this number 5% and 5%, you might have not much choice. Maybe either one will be okay, either you use train or you use an aeroplane. So because the risk of accident is 5%, all right? So that is what is meant by risk. So in financial statement, what is risk? Is a risk of material misstatement. Okay, risk of that particular statements, your financial statement is a mistake. So that is what we call a risk in audit. So let's go to audit risks. Okay, and here, what is audit risks? Okay, the first one is what is audit risks. Okay, risks the auditor give an appropriate opinion. Right? What is meant by inappropriate opinion is a risk that the auditor makes a wrong opinion. Okay, so there, for example, like the account, the financial statement should have a lot of mistake, a lot of misstatement happen, but your auditor are not able to detect. So there is a risk that auditor is making a wrong opinion. Why this happen? Because it could be auditor failed to identify the risks and they audit the wrong area, and then the particular plan is not able to detect the potential or the material misstatements. Okay, then we look at how does this audit risks and related to audit plan. It's very related, because for you to prepare audit plan, you need to have a proper assessment of risks, because you need to identify what are the risk area, what could be a problem area that could lead to the material misstatement. Then from there, you focus on what to audit, and you focus on what to audit, when to audit. That actually being explained or being narrated clearly in the audit plan. So then we talk about acceptable audit risks. Okay, acceptable audit risk is acceptable audit risk set by the auditor. Okay, how acceptable they are? Normally they are very simple measurement of these audit risks, maybe in terms of the we call the level of whether it is low, medium, or high risk. So if the auditor is we call set your acceptable audit risk is high, then they need to get more evidence to collect. If they anticipate, they plan to accept a low audit risk, maybe if low if they plan to accept low audit risk, they need to have more evidence. If they plan to have high audit risks, then maybe they just takes a small number of evidence. That is audit risk. Again, to wrap up this particular part, okay, what is important is what is audit risk. It's a risk that auditor is making a wrong opinion, and of course this audit risk is very important in audit plan because it's help you to design the audit plan. Okay, and then audit risk is actually the assessment or measurement by the auditors. What are the acceptable magnitude, what are the acceptable level they want to set, low, medium, and high. Low audit risks, if they want to accept low audit risks, they need to get a very comprehensive audit test, so more evidence will be collected. If it is they anticipate high audit risks, that's why they might need not to get more audit evidence. Okay. Now let us see how does this auditors respond to risk assessment. Okay. Later on, we'll look at how the risk assessment is being conducted. Okay, and first thing is, the auditor need to assess the risk of material misstatement. So there are a lot of ways. We are going to go into detail of how actually this risk assessment is being done. Okay, once they assess the risk, so the auditor will need to, this is the second part, the auditor will need to determine the procedure, okay, necessary, okay, for them to assess, okay, the risks. Okay, then they identify whether it is low risk or high risk. If it is high risk, then the perform or the procedure of audit will be more extended, will be more detailed, will be more comprehensive. Where it's low risk, okay, maybe they just use a normal procedure in audit. This is how we call the response by the auditors. Okay, now let us see the audit risk model. Okay, the first thing first, if you have in the prior presentations, okay, and one of the point before the auditor accept the audit engagement, or they need to understand the client business and industry. So what do they need to gather? What are the data they need to gather? They need to see the industry external and internal environment. They have to see the business operation and process. They have to see the management of the governance, whether it's owned by is a public company or sole proprietor. So they need to see the audit, the objective and strategies, and also measurement and performance. This information need to be gathered to identify the risks. Then from this, then auditor assess the client risks. Okay, this is one. Then you see, then when they what are the risks, or the business risks, that they assess the risks for what? For looking at the material possible of risk of material misstatements. Okay, the risk of material misstatement can be we call caused by the inherent risks. We're going to go into detail what is inherent risks and also control risks. Okay, inherent risks and control risks. So then this is the audit risk model. I'm not going to share with you the audit risk model in this particular slide because the other one will be much better. Okay, now before that, okay, now this is what is audit risk model is about. Okay, so audit risk just now, okay, audit risk is this part. This audit risk is a risk that auditor is making a wrong opinion. And then what is the content of the audit risk? It is a function of the inherent risk and control risk and also detection risk. Okay, what is actually inherent risk? Okay, inherent risk is the risk of material misstatement occur ignoring the internal control. So here, this is all the business risks, or all the whatever risks that you can foresee. Okay, by ignoring the internal control. All right. So this is what we call the inherent risks. Later, we'll give you a certain example of what are the inherent risks. And what is control risk? Is a risk of internal control. That is a risk of we call the risk the internal control system will not prevent or detect any material misstatement. There is an internal control, Okay, but okay, we have covered internal control. What is internal control? But the internal control is not able to prevent or detect the material misstatements, okay, or do some correction before the material misstatement happen. So there is a control risk. Okay, sometimes if the control risk, if the internal control is good, is properly implemented, is effective, then control risk will be very low. If it is not good, then control risk is going to be very high. Okay, then go to the detection risk. What is detection risk? Is the risk that the auditor test will not detect the misstatements. Okay, they conduct the audit test. However, the test cannot detect the misstatement. So here, detection risk is really the risk of the auditor are not able to detect. Okay, but this one is a inherent risk is the organization. Okay, inherent risk is a risk at the organization level. So, and control risk also a risk at the organization level. So these two actually a risk of actually contribute the risk of material misstatement. Okay, now let's look at this diagram. Okay, it helps you to understand better what is inherent risk. So here, inherent risks are all the risks 1, 2, 3, 4, 5. They are all these risks. Okay, that could happen. Okay, that could happen. Then in the organization, so that could happen. This is not internal control. Okay, inherent risks are all the material misstatement that could happen. Where there is no internal control. However, when there is an internal control, this one usually we call visualize using a sieve here. Okay, you can see all this sieve, and then this sieve is supposed to filter the risks. Okay, maybe some of the risks is being filtered here. You can see here by the control risks. So if the internal control is good, they can filter more. Right? If it is not good, then they cannot. There are some of the risks might go down. Okay, might go down. Some of the risks of here they are not being filtered. Okay, not being filtered. So like 1, 2, 3 here, maybe just go through because the internal control here is quite weak. Okay, but some are being detected. Okay, however, now is some of it already go through the control risks because they are not the control risks are not able to not able to detect the what we call the risks. So because of weak internal control, this one, as you can see, a very big hole here. And then we go to detection risk. So some of the we call the undetected risk of material misstatement by control risk just now supposed to be detected by the auditor. The auditor is supposed to do some testing to detect all these material misstatement. Okay, maybe the auditor can cut some here. However, some still not being detected. Okay, this is where the audit risk is about. The auditor are not able to detect. Okay, not able to detect based on all these things. They said that the accounting is okay, but it's not okay. But because of there are some risks is not detected. Therefore, this the auditor give a wrong opinion. I hope you understand with this particular diagram. Okay. All right. So this diagram is also explain the how does the inherent risk, control risk, and this detection risk related to the audit risk. So basically, inherent risk is you can measure them, you can identify by using the audit assessment procedure, and then from there, then look at it's supposed to be you have to identify the level of control risk. So you need to understand the internal control by testing the internal control, the test of control. Okay, this is where you see whether the control is good or not good. Then after that, then you from this information, then you do some analytical procedure and test of details. This is what we call a substantive test to conduct the audits. Therefore, by using it, you need to using this analysis, using this assessment, then you can gather an appropriate and sufficient evidence, for in the conduct of your audit. Okay, it is the same thing, right? Inherent risks. Okay, just now, what is inherent risk is a misstatement likely to occur in the client financial statements, right? Now, in this case, see here, there is no internal control. And when there is internal control, we look at the control risk again. How good is the internal control? If internal control is good, the control risk become very low. If the internal control is not good, the control risk become very high. What is meant by low and high control risk is a risk that the internal control is not able to detect the material misstatement. So then we go to the detection risk. Detection risk is the risk the auditor is unable to detect the material misstatement. All right. Then when there is happen, when the detection risk is high, therefore the auditor is actually facing a risk of making a wrong opinion or making a inappropriate opinion. That is audit risk. Okay. Now, this audit risk resulted from uncertainty, something that is uncertain. Okay. Why is this uncertainty happen? Because of the nature of audit test. Okay, why? Because we not based on the census. We don't actually test the whole transactions. We do sampling, so not 100%. We do sampling. That is why it contribute to uncertainty. Sometimes it's due to inherent limitation, because some internal control maybe it is they may have a very good internal control, because there are some limitation of internal control to be implemented effectively. Why? Because due to errors, okay, human errors, maybe some carelessness, faulty judgment, management overrides, and low and poor communications. And then again, due to the nature of the evidence, our evidence collected by the auditor is a persuasive evidence, not a conclusive evidence. Why persuasive? Because we collect the evidence based on sampling. All right, so it is not conclusive. If it is census, if it is 100%, then you can say it is a conclusive evidence. All right. Again, explain. This is actually detailed explanation about what is inherent risk, as I said just now. Alright, okay, the risks related to the characteristic of the business. Certain industry may have prone to the inherent risks. For example, possible misstatement of sales figure. Okay, for example, a possible misstatement of sales figure due to a problem or risk of improper records or incomplete records. Okay, when you compare between two industry, or for example like Giant, supermarket, and also Periode 2 sales. Okay, you can see that okay, which of these particular industry have actually risk of improper or unrecorded sales transactions. Okay. We don't look at the magnitude, we look at the process. Okay, here you can see maybe the Giant or supermarket have a very high risk of improper records of sales transaction due to huge number of sales, huge of number cash sales. Whereas for Periode 2, the sales transaction may be very low, even though they have a very big magnitude, but the sales transaction is low because the client is not actually paying cash. Okay, they pay they use bank loan to settle the payment. Therefore, the risk of improper records or the risk of incomplete records in sales will become very low in Periode 2. Therefore, you can see some industry have a different level of inherent risks. Okay, another thing is they can also relate to transactions. Okay, if you are actually auditing inventory as compared to audit the transaction of payroll, okay, inventory can be more risk of incomplete records or wrong valuation of records. Why? Because they have a lot of transaction involving the inventory, okay, a warehouse, because a lot of things need to be checked. However, for payroll, because it is very routine, so maybe they are less prone to be to have a mistake in the material misstatement. So they also related to transaction also. Okay, here in inherent risks, internal controls are being ignored because they are considered separate in audit risk model and control risks. Okay, again, this is inherent risk can be divided into both. Can have into two level. One is a statement level or entity level. The other one is balance level or transaction level. So inherent risk for these two level. Okay, for statement level or entity level, we go into detail about explaining what is the other financial statement level or entity level, and or maybe the other second level is at accounting balance and transaction level. Okay, what are the actually inherent risks at the financial level or entity level? So it depends on the nature of client, business size, number and location of the company, because different industry may have different level of inherent risk at the financial statement or entity level. For example, like inventory in electronics, manufacturer is a risk of the inventory become obsolete in electronic or in mobile devices is higher than compared to the steel fabricator, because the level of the energy is very volatile and they change easily, and then the valuation become very risky. And then depend on the management. It depend the experience, integrity, attitude of directors and management. Sometimes maybe you can look at the management. If the company is actually have a very high management turnover, they keep on changing the directors, they keep on changing the staff inside there. Maybe that particular entity or the organization is at a very high inherent risk. Why? Because they have lack of experience, they have lack of they have not the integrity is not being measured properly, and then sometimes we don't know the attitude of the directors. Okay, maybe when we talk about the ownership of the organization, if owned by sole proprietor, maybe the possible misstatement could happen, have even more as compared to public companies, because of the internal control or dominant control of the organizations. Depend on the management. And then sometimes the management also might have an unusual pressure to the staff. The staff maybe the management keep on pressuring the staff to report on deadlines, report on KPIs and everything. So due to this, the staff might be tempted to fabricate the data, tempted to do some material misstatements to achieve the KPIs. Right? Then this could be the possible reason why we can have high inherent risks. Right? Maybe we can also look at the results of the previous audit. If the previous audit have shown certain misstatement in that particular area, so you can anticipate that high inherent risk in that particular area. You can look at the result of previous audit as well. So again, related parties. You need to study who are the related parties in the organization. So if, for example, like the holding and the subsidiaries. If you can see that it's the same person or the same major shareholder in holding and also in the subsidiaries, they are not independent parties. So issues of risk of wrong valuations of intercompany transfer or intercompany transaction could be high if the related parties is not independent. And then sometimes also we are facing we are actually experience a non-routine transaction, something that is not common in that particular business organization. For example, once a while, maybe once in 2 or 3 years, we sell our fixed assets. Sometimes due to this, or maybe once in few years we do renovations. Due to very non-routine transactions, maybe a renovation, for example, it's supposed to be treated as a adding value to your assets, so it could be treated in a balance sheet rather than in a profit or loss. Why? Because sometimes we might wrongly transact the renovation as repair and maintenance. So this could be a possible reason why inherent risk could be at higher level. All right, now how about inherent risk at account balance? This is it. Why is this happen? Because all those sometimes all those transaction is based on judgment. There's no specific or standard rule of present this particular industry, the provision for the full debt is this percent and so on and so on. There's no such standard. It's always based on the management judgment. It's very subjective. That is why the inherent risk in accounting balance is very dependent on the judgment of the management. For example, like undoubtful debts, depreciation, useful life of assets. These are based on the judgment of the management. Again, this particular area is exposed to inherent risks. Other facts, other things that you may consider in account balance and transaction level are the complexity of the transactions. If the transaction is very complex, it's prone to have an inherent risk on the balance. And then we look at the certain assets. Some assets are so susceptible to be misappropriated. Okay, we have to look at that issue as well. Okay, and then we look at the quality of accounting system. Okay, maybe we have an accounting system that have very poor internal control or everything, or no internal control at all, or you still have manual, you still have don't have a proper system in accounting system, so it can also prone to have an inherent risk. And then the completion of unusual complex transactions. Okay, normally because the transaction is very complex and need to be settled at the year end, so pressure of the completion of the transaction become very high. So that is why that could have chances of contribute to the high inherent risks. Okay, now as I said just now, these are very the explanation about what are inherent risks at transaction level and also account balance level. Okay, again, we have gone through the inherent risks. What is inherent risks? Now we go through. We have covered this part. Okay, now we might go through what is a control risks. Okay, what is control risks? Okay, according to ISA is a material misstatement that could occur and not prevented or detected or not corrected on timely basis by internal control structure. Okay, in a layman term, it is where the internal control structure are not able to detect or prevent or make corrective action on timely basis of the material misstatement. That is what internal control risk is about. It's a risk that the internal control are not able to detect the material misstatement or can make correction or make or detecting or prevention of the particular material misstatements. Okay, so basically, if you have an effective internal control, it helps to reduce the control risk. Good internal control or effective control to reduce the control risk. So what is the role of auditor? The auditor need to understand the level of the internal control, how effective is internal control, to assess the control risks. That is very important. Okay, all right. However, some internal control might have a problem in terms of implementation because it due to the cost. Okay, sometimes you might want to have a good internal control, but it is very costly. That's why it is not that we need to balance between the cost of having a good internal control with the benefit that you have internal control. Okay, now internal control was mainly for routine transaction, because sometimes for non-routine we are not able to have that internal control because we have problem or limitation in terms of resources to implement the internal control. So as I said earlier just now, internal control can also be overruled. Why? Because of carelessness, ignorance, and also rejection from the employers, and also sometimes due to the reason that the employees might don't understand the instruction. They don't internalize the internal control. They are not in the system yet. They are not in the culture yet. So this could happen. Internal control might be bypassed by the management or employee. Why? Because through the collusion. Okay, sometimes the management may overrule or override the internal control. Right? This is internal control become not relevant due to changes in condition on environment. So maybe some internal control might no longer relevant in the current business environment. For example, like in a business transaction nowadays, so due to the COVID-19, internal control related to physical sales is no longer relevant because most of the sales now conducted using a online base. So there could be some example of irrelevancy of the internal control. Okay, now internal control can be also divided into level. One is general level and the other one is specific level. What is general level? So here this we look at the attitude of management towards the importance of internal control. So we look at the business as a whole. Look at the management. If the management have a positive attitude towards the importance of internal control for the business, then you can anticipate that they have a very good internal control. So the internal control become very good, and also control risk will be very low. So here the next part will be a specific level, where the auditor should also consider evaluate whether existing control procedure is good enough to prevent the detect the errors or not. So here the auditor look at the specific transaction or specific process. So they have to see whether, even though the at general level just now the management have a very positive attitude about the importance of internal control, they come up with very good policy about internal control. However, at transaction level, if it is not implemented properly, then we have a problem. So that is why the auditor need to assess the particular risks of control at transaction level or at process level as well. So here you can have conclude that control risk will be higher if the internal control is not effective. Right. Now again, we have go through what are the internal control. Let us look at the detection risk. Okay, the control risk. So what is detection risk? Okay, auditor substantive. Okay, the auditor risk is the risk that an auditor's substantive procedure will not detect any material misstatement occur. Okay, we have identified the inherent risks, we have identified the control risks, and then now the issue is here whether the process, the tests are conducted by the audit are able to detect any material misstatement. Okay, now detection risk just now is a risk that the auditor are not able to detect this financial misstatement. Okay, this is the only risk that can be controlled by the auditor. How to control the risk? Detection risk, maybe you have a very good we call process of risk assessment, process of we call assessing the control risks, and also the number of evidence. These are controlled by the auditors. So if the auditors are not able to control it properly, then they are prone to be exposed to the detection risks. Okay. Now, therefore, the auditor will need to consider the following to minimize the detection risk. So they must have an appropriate planning, direction, and supervision during audit work. Okay, here the audit work need to be supervised properly and also have a very good planning. All right. And then the nature of substantive procedure, they have to have a very good and proper substantive procedure. If sometimes they need to have an extensive substantive procedure. Okay, the timing should be proper. All right, and also the extent of the substantive need to be proper as well. So these are the things that helps to minimize the detection risks. All right. Okay. Now, again, detection risks are the audit procedure. The audit procedure carry out a sensitive test, as I said earlier, and an analytical review. The auditor can do the audit test using both audit substantive test and analytical review. Okay, you can see that how does this related? If inherent risk and control risk are high, the level of detection risk is low, as I said just now. And if the inherent risks are high and control risks are high, okay, the detection risk is low. Why? Because if it is high, if the auditor anticipate the inherent risks are high and control risks are high, they will gather more evidence. That's why the detection risks become very low, right? So we'll look at that into some rubrics or metrics later on, right? So here give you an example. These are the level of the inherent risks. You can divide into high, low, and medium. The same as the control risks, high, low, and medium. These are all the level of detection risk. Okay, so to give you an example, if the inherent risk is high, okay, here now, and the auditor's assessment of internal control is also high. Okay, here maybe it just as you compared just now, this transaction is maybe for inventory high risk, and then internal control is also very low in inventory. There's no proper control in the warehouse. That's why, so the auditor will have to gather more evidence in auditing the warehouse. That's why they have a lowest detection risk. They gather more evidence, so they will be able to detect more. However, now I give you an example of auditor assessment of inherent risk in low area. Inherent risk in low area. For example, in payroll. Payroll, you know that inherent risk is low. Why? Because you know that that is a very routine, and you know that they're using a good system in preparing the payroll. Okay, and also the control risk is very good. They use password and everything. So what the auditor do? Okay, we have no problem with that. So we select very small sample or small evidence. As such, they exposed to highest detection risk. Why? Because there are some other transaction that is not being tested. It's not being tested. Then possibility that particular transaction that are not tested, that can have the potential misstatement could be very high. That is why the detection risk is at high level. If you have a very low inherent risk and also low control risk, so detection risk is high. So you can this is actually the how does this audit risks inherent risks related to the inherent risk and also control risk. Again, these are just explanation of what we said just now. For example, like if the payroll is low, inventory is high. Okay, therefore the assessment of mental impairment is inherent risk is low, and this is just a comparison just now. Okay, between the we call the inherent risk and internal risk. So for example, like inherent risk in payroll is low. Why? Because of very we call small transactions. Control risk is good because of the proper internal control password and everything. Okay, so the audit rate become very low. However, the detection risk will become very high, as I said just now. Okay, this is how it's explained. Okay, now how does audit risk relate to evidence? Okay, what is audit risk? A risk that the auditor make a wrong opinion. Okay, it have a inverse relationship. Okay, if the number of evidence is low, the audit risk become very high. You can say that because some of the evidence is not detected, therefore risk of making a wrong opinion is high. Okay, this is what I said earlier just now. And then how about materiality and audit risks? Okay, here is very important to understand the concept of materiality. All right, so we'll go in detail about materiality later on. So basically, just to have a preliminary understanding of materiality is materiality is something that is significant, something that is important. If you set a low materiality level, meaning that if you audit as an organization and then you set your materiality level is 10,000 ringgit, so any misstatement above 10,000 is considered material, is considered important. So that is why if you set your materiality level is at low level, that's why you need to get the more audit evidence. If you set your materiality level at very high level, for example, like 1 million, So meaning that you only consider any misstatement that is more than 1 million that is considered as a important or significant. So you gather on less evidence in a if you set higher materiality level. So again, let me tell you what is materiality. Is a level that you set on how important is that particular amount. If you think that anything above 10,000 is very important, so you are setting that 10,000 as is your materiality level. Therefore, anything above 10,000, if there is a problem in anything above the 10,000, you said is very material. So your audit process become very detailed, become very complicated, and also the audit work become more complicated, and you need to audit more comprehensive as compared you if you set your materiality level at 1 million. But that depends on the industry or size of organization. So that is a relationship between materiality and audit risk is a low level, okay, materiality will give you high level of audit risk. Okay, there is an inverse relationship of materiality and audit risk, meaning the lower materiality level, the higher the audit risk, and vice versa. Okay, the example, reducing the materiality amount from 1 million to 100,000 and gather the same audit evidence. Okay, you gather the same amount of audit evidence, but you already reduced from 1 million to 100,000, meaning that, so if sometime like if you set the audit evidence to be about 100 transactions for 1 million, but now you reduce your materiality level to 100,000, but you still gather the same amount of evidence, 100 transactions, you are experiencing an audit risk. Okay, a risk that you are not able to detect the material misstatements. However, if you do it proportionally, if you set 1 million as your material level, okay, you have 100,000 and 100 sample of transaction, and you reduce 100,000, your material level reduced to 100,000, and your audit evidence will also increase. You said it's increased 10 times because it's 10 times lower, so 10 times higher, so 10 times lower of material level, and you increase your evidence 10 times lower, maybe your audit risk will be the same. Okay, but if your audit evidence or audit evidence is the same, then you can you are exposed to audit risks. Okay, this is what is the explanation is about. Okay, I hope you get that clear in terms of what is materiality is about. Okay, this is what is materiality. Significant to overall financial picture. You can see how significant, how is important this particular part. Okay, to whom? To the auditor as well as to the financial statement user. Okay, how significant is that amount? If you said 1 million is significant, so you say that only any mistake above 1 million, then you consider as a material misstatement. Right? So if 10,000, it is 10,000, more than 10,000. So you can look at that example, right? So materiality is just a magnitude of omission or misstatement of accounting information that makes probable judgment of a reasonable person relying on the information would be changed or influenced by the omission or misstatements. So here is actually the magnitude, the level of omission or mistake. Okay, if the company is high, is a big company, maybe the materiality level will become very because you cannot compare an apple with an orange. So because some material level at certain size of industry could be different. So, and again, materiality is a magnitude or level that omission or misstatement that you want to look for. And some user might say different level of materiality level. So they have to this why it's depend on the professional judgment of the auditors, right? Okay. Let us understand the concept of materiality in terms of this analogy. Yeah. Now, what is okay? Just now we have explain about risk of accident between if you are using train and aeroplane, they both have the same risk of accidents. Okay, train is 5% and also aeroplane is 5%. However, in terms of materiality, we look at the rate of survival. If 5% 5% of the train involved in accidents, the rate of survival that you anticipate is about 50%. So about 50% survive and 50% will die. However, even though the risk of aeroplane accident in aeroplane is only 5%, this 5% will actually give you a zero rate of survival, meaning everybody will die. So you can see here the materiality of aeroplane is lower, 0%, as compared to the 50% to train. So meaning that which one is that you think is more significant here? Okay, 10% is very significant. Okay, 0% is very significant for aeroplane, but 50% is not that significant in train. Why? Because we can anticipate another 50% survival rate. So you have to understand this concept, right? So as such, when we to reduce the materiality, to reduce the problem, we need to gather more testing or more evidence of safety checklist, yeah, for aeroplane. But here, maybe only a certain checklist this need to be checked. For example, for train, you don't need to check the steel tire. You don't have to check every day. But every aeroplane, they need to check the tire already, because it's very important. Part of an aeroplane, okay, that is being used for takeoff and landing. Because any failure of the landing wheels, they will cause a very fatal accidents in the aeroplane. This is very important. So you need to try to understand the analogy of the train and also then aeroplane. Right. So what are the steps in applying materiality? The first one is you need to establish a preliminary judgment of the materiality. You need to judge first. Okay. Then you need to determine the tolerable misstatement, whether it's 10 million, whether it's 1 million, whether it's 100,000. So you need to the next thing is you need to estimate the likely misstatement compared to the total preliminary judgment about materiality. How likely it's going to be happen. So there are steps of applying materiality. Then again, just now, as I said just now, concept of materiality, materiality is something that influences the economic decisions, right? So it also said whether it is important or not important. So if you think 10 million is very important, then you set your only 10 million transaction is important. Okay, if you think 10,000 is important, you set that materiality as a 10,000, because it depends on the industry or it depends on the size of the organizations. All right. Okay. Here, okay, the in term of concept of materiality is actually affect the sampling. Okay, and also material misstatement can actually resulted from errors and or fraud. Okay, errors are mistakes that is done unintentionally. You wrongly calculate, you wrongly record, but fraud is different. Fraud is something you do intentionally. You purposely fabricate the data. You purposely have something that you create, something that you falsify. So these are all the fraud. And then again we go into sampling. Again, materiality is a relative concept rather than absolute. Okay, so here for example, like if you set 1 million, material level of 1 million, okay, for small company it could be material, but for big company it is not material. It is not important. 1 million is very small amount for big company. That's why if you set 1 million in IBM, in Petronas or IBM, 1 million is not material. So you might set even at higher level of materiality. But 1 million for SME, that become very material to the company, right? That is materiality. So materiality, okay, concept materiality, okay, can be set, okay, based on quantitative or qualitative. Okay, maybe you can set the materiality in terms of percentage of the total assets, total revenue, income, gross profit, or maybe a previous year income. You can set in such a way that, okay, that's why just now of 3% or 5% of company A with high total asset might not be the same as a 3% to 5% of a company with a very small total asset or small company. That's why materiality just now is a relative rather than conclusive. So you can set the metric level based on quantitative, okay, in terms of a total number of assets, revenue, and so on. However, you can also set your materiality, okay, based on qualitative factors. Okay, for example, if you are firstly engaged in the organization and you have no experience in that particular organization, this is where maybe you can set a low level of materiality. Maybe you set instead of 1 million, you set to 500,000. Okay, and then when you conduct your test of control, you see there is a problem in the internal control. So what you do? Then you set a lower level of materiality. Right? Then you look at management again. If there is a high management turnover, you can see that, oh, the new director is being appointed, the new manager is being appointed. So you know maybe this as manager or director have less experience. So you think what the misstatement will be higher. That is where you set a lower level of materiality. Again, due to market pressure. Some industry are facing market pressure. For example, like currently with the COVID-19, some industry is having a problem. Airline industry. Maybe next year, when we conduct the audit for airline industry, then we set a lower level of materiality. And also high fraud risks. For example, like cash transaction and credit transactions. If the organization are very highly involved in cash transactions, so fraud risks become higher. That is where maybe your material level can be set at lower level. Okay, for example, just now we have Giant and Perodua. So Giant involve more cash transaction. Therefore, fraud risks of stealing the cash will be higher in Giant supermarket. And that's why you can set the low material level become lower for that company. Okay, and then also if it is higher than a normal risk of bankruptcy. If you know the company is having issues of going concern, a problem, the company will not survive. Therefore, the materiality level can be set at lower level. Okay, here this is just an example of the quantitative guidelines of deciding the materiality threshold. Maybe if you based on turnover about 1%, profit maybe 10%. Again, total asset will be 1% and equity 1%. Okay. Again, this depend on the industry, right? Okay, this is as I said just now. Okay, materiality qualitative is factor is depend on whether it's prone to fraud. And then, is there any consequences of contractual obligation? If there is, then you have to set become very low. And then, of course, does that affect the trend of earning? Okay, if you make an analysis, for example, like For over 5 years, you see the increase of 5% in terms of the income. However, this year declined to 1%. So you see there is a problem here. That's why you can, from this particular analysis, you set your materiality level become very low because of there is a change in trend become very low. So could be there could be a possible misstatement happen. Okay, maybe some misstatement are not immaterial but still need to disclose by the disclosure requirement. So certain information need to be disclosed. That's why you have to set the material level at very low because of the requirement of disclosure. Alright, again, okay, these are all the materiality guidelines just now. As I said, it's depend on the auditor judgment. Alright, it's depend on the auditor judgment of how to set the materiality level. So it's always depend on the experience of auditors. It's always depend on the we call the competency of the auditors. So that is why this material level normally the audit plan is done by the seniors. Okay, then because they have experience in conducting the audit. Okay. Okay, now as I said, this is what we mentioned just now. The qualitatively we use income statement or balance sheet statement. Again, now let us see how does this risk, materiality, and audit evidence related. Okay, as I said just now. Okay, here between train and aeroplane, you can see the rate of survival is 50% for train and rate of survival is 0% for aeroplane. Therefore, here, okay, looking at the high magnitude level of the materiality, you said just now, because of a 5% accident resulted a 0% of survival, very high chance of fatal accidents. Okay, everybody will die. Therefore, you need to gather more evidence. They need to gather more checklists. Okay, this is the analogy. But however, if your magnitude of materiality is magnitude of risk of survival is low, therefore you don't need to have more checklists. This is how does the evidence is related using this analogy. Okay, now, okay, in terms of financial accounting, if it is high risk, what are the risks just now? Inherent risks, control risks, and also detection risks. Okay, if it is high risk and of inherent risks and high risk of control risks, you need to gather more evidence. Why? To reduce the detection risks. Okay, you need to have more higher evidence or more evidence. However, if your materiality you set it at high level, okay, between 1 million and 100,000, 1K. Okay, if you set at 1 million, so you don't need, you say if you set your material level at 1 million, you said just now, only misstatement above 1 million is significant. Therefore, you will collect less evidence. However, if you set your materiality level at 100,000, so you said that anything above 100,000 is material. Okay, to reduce the audit risks, you need to gather more audit evidence. This is how it related. So guys, so I hope you understand the concept of risk, materiality, and how does this related. Okay, and also how does this relate to the audit evidence. Okay, high risk, high evidence is needed. If it is high inherent risk or high control risk, you need to gather more audit evidence to reduce the detection risk, so that it will help you to reduce the audit risk of making a wrong or appropriate opinion. Okay, when look at materiality, if you set your materiality as high, 1 million for example, so you said that anything above 1 million, any misstatement above 1 million, that is considered as a significant, as a material. So from that, you don't need to gather more evidence. You only focus on evidence that is only related to transactions more than 1 million. However, if you set your materiality become very low, for example, like 10,000 just now, so you say that any misstatement above 10,000 is material, is significant. So you need to gather more audit evidence. Okay, anything above 100,000 you need to check. So you need to gather more audit evidence. Why you need to gather more evidence? Because you want to reduce the risk of detection risks. Okay, where you are not able to detect the possible misstatement. So by increasing the audit evidence, so you reduce the detection risk. Of course, it helps you to reduce the audit risk of the auditor making inappropriate misstatements. So I think that's all for this particular topic. So I hope you understand. Okay, let me wrap up for this particular transaction. So the first thing you need to know is about audit risks. Okay, what is audit risk? Is a risk that auditor is making a wrong opinion or inappropriate opinion. Okay, then it is a function of inherent risks. Okay, the risks of the industry, the possible misstatement that could occur. Okay, when the internal control is ignored. And then it's a function of internal risks and control risks. Okay, risks the internal control cannot detect, detect, prevent, or make correction of the misstatements, and also detection risks. The risks that the auditor are not able to detect the financial misstatements. Okay, audit risk is the inherent risks. Time by control risks and the detection risks. Okay, all right. So we talk about materiality. High materiality. Okay, when you set high materiality, what is it? Is low audit risks. Okay. However, it require to also low evidence. Okay, if you set your materiality very low, okay, we call the if you set your materiality very low, you will have high audit risks. Why is this happen? Because you need to gather more audit evidence. Okay, this is very important. Okay, audit evidence. Okay, now I hope you can comprehend and internalize about risks and materiality. So with that, I hope you get a clear understanding about risks, materiality, and evidence. And then this is very important for the auditor to set the anticipated or the acceptable audit risks, okay, by measuring the inherent risks and control risks, and also the detection risks, to help them to make a proper plan of audit, and also to make sure that the audit process is being done correctly. Okay, thank you very much for your time. So I hope to see you again in next presentation. All right. Okay, thank you very much.